Hey, welcome back. Do you believe that the experience you have with your money is just 0.001% of what's happened in the world of money? And this video is about the book which I read recently, The Psychology of Money by Morgan Housel. It's about how to and how not to handle your money that helps to manage wealth, greed and happiness parallelly in your life. And this video is not like a book review. I haven't completely covered about this book in this video. I'm going to share the things which I'm going to use in my life or my takeaways from this book. And the beauty is, the things shared in this book is not only applicable to managing your money, but can also be helpful to most parts of your life. So watch the video in both perspectives. Let's get started now. The first thing is, take risks when you are winning. I like to share two examples from the book about Amazon and Netflix in taking risks. In 2014, Amazon launched Fire Phone, which didn't take off well in the market. Turns out to be an utter flop model for Amazon. Jeff Bezos shared this statement with his shareholders after the disastrous launch of Fire Phone. That is, if you think Fire Phone is a big failure, we are working on a much bigger failure right now. I'm not kidding, some of them are going to make the Fire Phone look like a tiny little blip. Why he said like that? Because Amazon was good to fail at that time because they were making good profits from Amazon Web Service, AWS, which is their cloud computing service. Still, AWS is the most revenue making business for Amazon. So they can offset the Fire Phone loss with the AWS profits. The next example is from Netflix. CEO Reed Hastings announced that they were cancelling their most big budget pictures right now and shared the reason why. Our hit ratio is way too high right now. I'm always pushing the content team, we have to take more risks. You must try more crazy things because we should have a higher cancel rate overall. Likewise, try to take risks in your investment when you are winning, not when you are losing. You have got to take risk when you have booked enough profits from your portfolio, so you can compensate the profits with the losses if you are going to make any for the risk you are going to take. Don't take risks in a portfolio which is already in red. Speaking of red, check out my stock portfolio which is in blood red, shared in iCard and description, watch it later. With this said, let's go on to the next one. Stop moving your goalpost. The hardest financial skill is getting your goalpost stop moving. Let's say you have decided to do a swing trade in a stock for 8% as your target and you have reached the 8% in 1 week time, and now your greed tells you to go for an additional 2% instead of exiting from the stock, and by next week there is a negative news on the stock, so the stock tanks to minus 2% from your investment value. Don't say that this will not happen. This happens for everyone. If you had a good enough mindset, you will be exiting from the stock when it is 8% and not waiting for additional 2% and eventually making a loss and regretting later that I should have exited at 8% itself. We all need to have an enough attitude in investment as well as in our life. If you don't have that, you are not going to make money in your investment. Seriously, I'm saying. If you are moving your goalpost every time after reaching your goal, it means you are taking more and more risk at each step. Remember this, happiness is just a result minus expectation. And the next one is, keep the odds in your favor. Our short-term failure in your investment should not impact our day-to-day financial situation. Short-term failure means a loss from a trade or a bear market. These things should not affect your daily finances. I did this before, investing all the amount in equity and without having any emergency funds or savings. If I need money from the equity, let's say my portfolio is in red, at that time I have no option, I have to withdraw for a loss. Thankfully it didn't happen for me, but I can't say it won't happen. So play safely by investing the amount which you don't need for next 3 to 5 years. In this way you can keep running for a long time until the odds are in your favor. The odds are in your favor means a bull market or your portfolio is in a profit zone. And the next one is, cash is the king always. No one wants to hold their cash during a bull market. They want their extra penny which is sitting idle in their bank should make money for them during a bull market. If it is in the bank, it may produce them 3% interest at the end of the year. But if it is in a stock in a bull market, it would make them 3 to 4 times the bank returns. Think of it, if all your money is invested in a bull market and it suddenly changes to bear zone. This happened last September to October. It changed from bull market to bear zone. Now suddenly you have an emergency expense. Now you have no option, you have to withdraw from the stocks for a loss. When you compare the amount withdrawn from the stock for a loss with the initial invested amount, the loss will be very high because you sold it when it is in low. In the same scenario, you are sitting on enough cash and you can handle that emergency expense with the cash in hand. Here cash is the one which prevented you from selling the stock. Now the actual return you earn from the cash is not less than 3% which the bank gives. It could be many multiples of that because you saved a stock from selling it for a loss. It is true that cash is king always. Let's go on to the next one. Don't follow extreme examples. We all make a mistake when following people. There will be extremely successful people who are known for their extreme success, like the billionaires and the CEOs. When following extreme examples, their outcomes also will be extreme, and the chances of using that in your life will be very little or sometimes of no use to you. Napoleon's definition of military genius was the man who can do the average thing when all those around him are going crazy. When following extreme people, we are not watching the average people around us who are making good progress and help you to make good progress. For example, you want to learn dance, you can find a pro-level dancer who have an experience of 10 plus years and you can join his class and you can learn dancing. But if you find a dancer with a 2 or 3 year experience, he can help you more than the pro-level dancer. A guy with 2 or 3 year experience can help you more than the guy with 10 year experience on the beginner level. He knows the difficulty of a beginner, but he felt that 10 years before, he felt this recently and he can pinpoint those things and he can change those things to you. I'm not telling it's not good to learn from the pro level. At the initial stage, you don't need to go to them. And the good thing is they are easily accessible to you than the experienced one. They are accessible in the form of PMS firm, portfolio management services and financial advisors and YouTube channel like us. If you want to learn more from an average YouTube channel, just press the subscribe button and hit the bell icon. Try to follow average people instead of following Warren Buffett or Rakesh Jhunjhunwala investment pattern. And it is also hard and the results are so extreme. The next one is have no sunk cost. There was a writer called Daniel Kahneman. When authoring his book Thinking Fast and Slow, he works endlessly on a chapter and completes it. But the very next day, he comes up with a new final version which will be completely different from the one which he finalized the day before. When one of his friends asked him, how could you start again like if you have never written earlier draft? And he said, I have no sunk costs. Sunk costs means anchoring to the decision you made in the past and not changing them. It is equivalent to a stranger making a major decision for you and you sticking to it. Take your investments and look, there will be many wrong investments you may made in your life. It can be picking a stock or mutual fund which is not performing well, or like a share, don't invest your money in this policies video. You made the decision in the past, that means you are a different person at that time. Now your investment perspective is different, but you have got to accept that you are wrong and you have to quit from that investment. Don't stick to that investment because you selected it before. If it is not working, you should exit from it. And the next takeaway is returns are not going to make you rich. Morgan Housel pinpoints the one thing which I already believe. You can't build wealth with the returns from your investment. This is not fully true, but it is partially true. I usually don't mind at the returns of my investment. Then you can ask me then why you are investing. Yes, returns are important, but my view on returns is different. Let me tell you with an example. The Sensex average return for 30-year period is between 13 to 18%. If I invest in Sensex for 30 years, my return expectation will not be 13 to 18. It will be less than 8%. The return from an investment is not in my control. The controllable variable for me is the principal I am going to invest. The principal should be massive, as huge as possible. Always remember that your principal amount is going to make you rich, not the returns. I don't know this at my initial stage of investing. If you have a mindset of becoming rich only with the returns from your investment, change it now. It's not going to happen. We came to the last one, that is the room for error. In the previous part I mentioned I will expect only 8% returns from the Sensex. This is the room for error I am mentioning. We can't expect the same returns to happen again, that is the 13 to 18%. Our market is getting more stable nowadays, so we can't expect the same returns. We need to expect less than that. The room for error gives you the endurance to play the game for a long run with low expectations. And if I invested in Sensex for 30 years, whatever I am going to get above 8% is a bonus for me. Charlie Munger says the best way to achieve felicity is to aim low. In room for error, I have a question for you all. Will you be able to face a volatility of minus 30% or minus 25% in your investment? That is, if you have invested 1 lakh, if it goes to minus 30%, it will be 70,000. You will be able to face that. Many will say yes after working in paper, Excel sheet or without investing, many will say yes. But you can't handle the mental stress of it. Your confidence goes down, you think you have made a mistake, you are wrong, and that 30% volatility won't give you the guts to start the investment again. If you are following my video, you know that I am investing in crypto for speculation alone. Last year, cryptocurrencies were rallying to its all-time high. At that time, I invested 20,000 in cryptocurrency. Within a week, my 20,000 came to 10,000. And now its value is 3,500 rupees. I am also a guy who said that I can handle the volatility of the instrument, whatever happens. I know the stress I have gone through when it went down for that much value. This is where room for error needs to be used before making such investment option. You must ask yourself, I may feel okay with the Excel sheet, paper or a digital format with the losses, but will I be able to handle the stress of it if my investment goes down this much or my investment goes wrong? So leave space for room for error in your investment. That's all we came to end of this video. The things I shared now are the things I am going to use in my life. Subscribe for more videos like this in future and like this video if you find it useful and share to any of your friends. I hope my takeaway from the book, The Psychology of Money, will helpful for you to handle both money and life parallelly. Bye, take care, signing off, Peranesh.